Good morning. Welcome to our webinar on the magic of management buyouts. We do record this webinar, but we don't record any personal information regarding the names of people attending or any questions asked. We record it so people who join late or have to leave early can watch a copy of it later on YouTube. Thank you for joining us this morning for our webinar on the magic of management buyouts. What we're going to cover this morning is just a very brief introduction to ourselves, who we are, why we're qualified to talk about management buyouts, what's our experience. And then we're going to move on to get into the nitty-gritty of management buyouts, talking about the magic ingredients for an MBO, from a vendor's point of view, management team's point of view, a bit about funding, how we can help, and then we'll answer questions at the end. So please, if you wish to ask a question, please use the Q&A icon that's either the top or bottom of your screen. If you ask a question as we go along or towards the end, we'll pick up on as many questions as we can at the end. So I'm Andrew Coates. I'm one of the two directors of strategic corporate finance. Greg Barker, my colleague, will be covering most of this, the technical part of the presentation. We've got strategic corporate finance are in our 24th year, and we both had corporate finance experience before joining strategic. Our sole focus is acting for clients buying and selling businesses. So we've got a strategic, we've got nearly 25 years experience, and we believe in giving early stage advice. So a lot of our starting point for most clients or potential clients is some early stage advice as to what they can achieve, what is possible, what is deliverable. And therefore for many clients, we start looking at valuations. If they're vendors, looking at the valuation of the business. For management teams or acquirers, again, looking at considering valuations, considering ways of funding the deal, the different ways of structuring the deal. We carry out management buyout feasibility reports quite often before management buyout is the agreed course of action, which does look at the valuation, looks at funding possibilities, what the deal structure would look like, and sets out what can be delivered, what can be achieved. We often act for vendors in delivering management buyouts, selling to management teams, and we often act for the management teams in buying off vendors. And when acting for vendors, we sometimes are asked to look at different options. So look at the management buyout option and look at a trade sale option, and give a full exit option advice on the different options, likely values, market appetite, likely funding, to allow, it's a big decision when you come to sell your business. And to be fully informed as of the different options to allow you to take the right decision to move forward is something that we do on a regular basis. So our background is working full-time on transactions, many of which are management buyouts and many are trade sales, probably 50-50 split. There's a few of the management buyouts that we've completed over the last few years on this slide. And you can see there's a variety of different industry sectors we've acted in. As I say, often acting for vendors, often acting for management teams, and recognizing really in the case of a management buyout, the vendors and the management team have worked together as one team for many, many years, and it's a friendly deal, and it's a way of you need to find a way through the deal that delivers what the management team's aspirations are and delivers the vendor's aspirations at the same time. So it's a win-win for everybody. As I say, we're going to pick up on questions and answers at the end. I'm going to hand over to Greg at this stage. But if you have got questions, please use the Q&A button, ask the question, and we'll pick up and answer as many of those as we can at the end. Thank you.
Thanks for that introduction, Andrew. Good morning, everybody. Going into the content of this webinar, first of all, what are the magic ingredients for a successful management buyout? There's three key things really that I've noted on this slide. The first is ideally you need to have a profitable and cash generative business, and this is critical because it's the business itself that is going to be providing the cash that's needed to fund the management buyout. Really, unless it's a kind of a distressed business or an early stage business or a heavily indebted business, most other businesses will be suitable for a management buyout. The second magic ingredient is an owner or owners of the business who are looking to sell, and this is critical because it's very difficult to try and make a management buyout happen where the owners don't have that sort of desire to want to exit. So for that reason, we find that in the vast majority of management buyouts we work on, it tends to be retirement situations where the owners are looking to exit from the business and pass the baton on to their management teams. And the third and final magic ingredient is a strong and ambitious management team wanting to take the business forward. In an ideal world, that would be a sort of a relatively young management team that are running the business without any involvement from the current owners of the business. In the SME world, that's rarely the case. Usually, the owners of the business are actively involved in the day-to-day running of the business to a greater or lesser extent. And that's not a barrier to doing a management buyout at all. And indeed, sometimes the owners of the business might continue to be involved in managing the business after the transaction takes place, and maybe look to phase out of the business over a number of years. Perhaps they might look to sort of let go of the reins from an operational day-to-day point of view, but then move up into a chairperson role and just mentor the other members of the management team after the deal has taken place. And very often that's a desirable feature of a management buyout for the owners of the business compared to, say, a trade sale, where the owners don't want to have a complete exit and a complete a clean break from the business. They would actually like to remain involved and keep their have some involvement going forward. So moving on to the magic of management buyouts for vendors, and there's a number of very strong reasons why management buyouts often provide an optimum exit route compared to a trade sale. The first one is that a management buyout gives an opportunity to realise the maximum value for the owner's shares. There is a bit of a misconception out there that the best sale value will always be achieved by selling to a trade buyer, and sometimes that's the case if it's a trade buyer that is able to make cost savings or grow the business faster. They will be in a position to pay a strategic premium for business that might not be available through a management buyout. But very often that strategic premium it can't be realised. It's very likely that trade buyers will negotiate very hard on price, and that's because they will be taking on all of the risk of a business that they buy. So it's very important that any acquisitions they make are priced sensibly. If you compare that with a management buyout, very often the owners of the business are in a stronger negotiating position to get the deal value that they want compared to looking to sell to a trade buyer. And that's because of the way management buyouts are funded compared to how trade sales are funded. So I'll touch more on that later on in this presentation. But a key point to kind of get across is that the management team isn't funding the buyout themselves. They will usually be investing some of their own money, which is only a very small part of the overall deal value. So that should be the most critical thing for them, rather than the overall deal value. And that, of course, is what is most important to the exiting shareholders, the vendors. The second sort of big advantage of management buyouts for vendors is that it provides an opportunity to reinvest part of their sale proceeds and generate a high level of return on that reinvestment. So this can be a sort of a silver lining to the big disadvantage with management buyouts, and that is in most management buyouts, Some of the proceeds will be paid to the vendors when the deal happens, and then a portion of it will be paid over a number of years on deferred terms. So that can be a downside for vendors, and they've got to wait a length of time to receive all their money. But the flip side of that is that there's an opportunity to generate a return on that that ongoing investment in the company. And that can make a huge difference to the overall value that's realised from the deal. And very often, exiting shareholders are in a position where they need to reinvest the proceeds of a sale anyway, and it can be difficult to try and invest that in a way that provides the sort of returns that can be realised through investing in a small business. So I'll give an example of that on the next slide. So in this example, let's say that a company is sold through a management buyout for £3 million, and a bank is involved in funding that deal. Perhaps they provide a loan of £1.7 million. The management team would, let's say there's three managers who each invest £50,000 and receive 75% of the company for that. And the exiting shareholders reinvest part of their proceeds, another £50,000 for the remaining 25% of the company. The balance of the deal would be funded through deferred consideration, where the vendors get paid out, say, over the next five years. With this deal structure, the vendors would receive £1.85 million on day one, another £1.1 million on deferred terms over the next few years, and the £50,000 that they've reinvested into the company's shares when the deal happens. If the business doesn't grow in value at all over that time, and simply repays the bank loan and the deferred consideration, then all things being equal, the company valuation would still be £3 million after that debt's been repaid in, say, 5 years' time, and therefore a 25% shareholding in the company at that point in the future would be worth £750,000. So the overall value that's been generated for the vendors in this particular example would be £3.7 million, a sort of more than a 20% premium over and above the deal value of £3 million. So you can see in this example that although there's a kind of a risk associated with having to wait several years to receive the money for your shares, that sort of risk premium is reflected in the overall deal structure, and the vendors can realise a lot more from the deal compared to just cashing out on day one and receiving all of their money. The third reason why management buyouts can be magic for vendors is that it can be a much easier deal. You know who you're selling to. With any kind of deal, it's vital to have trust and goodwill between the principals involved. And with the management buyout, very often, that already exists, and therefore we can skip straight ahead to kind of getting the deal done, rather than spending a long several months or even years looking for the right third-party buyer. So it can be a much less stressful process for the management buyout compared to a trade sale. Confidentiality is almost always a really sort of important concern for clients, and with the management buyouts, there's an opportunity to keep the transaction entirely in-house, and even if staff members do sort of find out that a management buyout is being talked about, it's not going to be as sort of unsettling as perhaps finding out that the business is on the market and the owners are looking to sell to a trade buyer. Also, in many cases, there's no sort of desire to sell to a third party anyway. Very often, SMEs are family businesses, and a management buyout is an ideal way of passing the ownership of the business from one family generation to another, without sort of waiting for an inheritance event. Another sort of soft sort of advantage of management buyouts compared to trade sales is that there's an opportunity for the owners to secure their legacy. And legacy is a word that often pops up when we're talking to clients about what they want to achieve when they come to sell their business. And most business owners want to see the business succeed, long after they've exited from it. They want to be sort of happy that their staff are looked after and their jobs are secure and their customers continue to be served. So a management buyout for those sorts of reasons is often seen as far much more preferable to selling to a trade buyer, where they may run the business differently, or there may be sort of very, very significant changes in the business after it's sold. So with a management buyout, the business remains running as normal. There can be there don't need to be any major changes with the business. No job losses or reorganizations. And also management buyouts, they can provide impetus for a business to grow more quickly, and perhaps take advantage of opportunities that exist in the market. So very often business owners who are sort of thinking about the retirement and exits, they become more conservative about the way they run their business. They don't wish to take risks, and they perhaps have lost the energy and the drive to continue growing the business as quickly. A management buyout can be that catalyst for the next generation of management to look to exploit those opportunities and keep growing the business. As I've mentioned at the start as well, with the management buyout, there's an opportunity for the owners of the business to remain involved in some capacity if that's what they want. So it could be remaining as a chairperson or a non-exec, and continuing to have some sort of influence over the business and how it sort of is run going forward. The fifth one is a big reason, and something we see very often, and that is for some businesses, selling to a trade buyer can be completely impossible, and that could be for a number of reasons, but typical ones we come across is that it might be a business where there's an undue level of reliance on one or a small number of key customers, or there might be one or two key individuals in the business who are critical to its success, or it just could be a business where there's a lot of uncertainty over future profitability and cash flows. So it might be a contracting business that's reliant on winning a small number of large contracts. So those sorts of businesses that are high risk are generally unattractive to trade buyers. Smaller businesses as well can be very, very difficult to find trade buyers for. So in those situations, those risks can be overcome by pursuing a management buyout as an exit strategy. If it's a business where there's a lot of risk attached to key customers or key individuals, the management team are the ideal buyers, really, because they have they work in the business, they understand those risks, they perhaps will have those relationships with key customers, and therefore they can have a different perspective on that risk compared to an external buyer. And also coming back to the point about management buyouts being structured and funded in a different way to trade sales, the management team are only going to be investing some of their own money, or perhaps in some cases that personal investment might be a very nominal figure indeed if it's a risky business, and therefore even if it's a risky business, it can still be structured in a way that's very attractive to management, in a way that it wouldn't be attractive at all to a trade buyer. Andrew's mentioned this advantage of management buyouts as well in his introduction, and that is a management buyout enables the owners of businesses to have a great deal of control over the sale process in a way that you don't have with a trade sale process. So with the management buyout, it's possible to plan the deal well in advance, and perhaps communicate that plan to your management team in a way that incentivizes them to stay with the business. So a key risk with SMEs is that key managers leave to join competitors or set up on their own. So having a plan in place to deal with succession of ownership, even if that's several years down the line, can be a very effective way of securing your talent within your business. So you can plan ahead, you can shape the deal in a way that suits you. So if it is a deal structure where you there's going to be a retained equity shareholding and ongoing involvement, that can be sort of built into the deal structure. There can be a great deal of control over the price as well, within reason. So with a management buyout, it's possible to kind of take early advice, plan how it's going to look, warm up funders, make sure the deal's deliverable, and sort of have a great deal of certainty that a deal can be completed by a certain within a certain time scale. And that can be a real big advantage compared to the trade sale route. So I've listed a number of strong reasons why management buyouts can be a great option for the owners of businesses, but they can also be fantastic opportunities for the managers working within businesses. And the biggest reason why the management buyouts are magic for managers is the gearing effect, and that is how a relatively small personal investment can grow very rapidly through the way that the deal's been structured. So this chart on this slide sort of tries to illustrate that point. So again, going back to the earlier example, if it's a £3 million management buyout, maybe there's three managers plus the exiting shareholder who invest £50,000 each in equity on day one, and then the rest of the deal, the £1.8 million, is funded through a mixture of bank debt and deferred consideration. But then as the business moves forward and generates cash flow, that debt is very quickly paid off. So by the end of 5 years, you might find that all of the debt has been repaid, and that £200,000 equity value on day one has grown to £3 million in the space of 5 years. So that sort of level of return is something that you can't get in many places at all. It really is a sort of a once in a lifetime opportunity to kind of transform personal wealth, and that slide only shows the value that the possible growth in valuation if the business stands still and doesn't grow its overall value during that time. Very often, as I've mentioned before, very often management buyouts provide an impetus for a business to grow even faster. The management team will be incentivized far more than before to put extra effort into the business and grow it faster, and therefore usually you would expect the overall value of the business to grow during that time scale as well. So that's all. That level of growth is just illustrating what can be achieved if the business stands still. If the business grows as well, then there's an even greater potential for generating wealth. And then some sort of softer reasons for why management buyouts are great for managers. There's an opportunity to take control. So very often we come across situations where the existing managers perhaps might be frustrated with how the business is operating. Again, it might come back down to the fact that the current owners are looking at their own retirement and therefore not driving the business and taking advantage of opportunities. So there's an opportunity to take the business forward through a management buyout, secure your own long-term future. So if it was while ever you're an employee, there's always a risk over your position. If the business was absorbed into a larger group, then there's a risk there. So being a business owner enables you to take control of your future, and as well as the long-term opportunity to transform your sort of personal wealth in the short term. Often it's appropriate to increase your basic remuneration because of the fact that you'll be taking on more responsibility, and probably needing to invest some of your own money into a deal. So short term, it's likely there'll be an increase in remuneration, and then medium to long term, once the debt gets paid off, there's an opportunity to receive dividends and enjoy the benefits of company ownership. So those are the advantages of management buyouts for vendors and for managers. I'll just quickly talk about how management buyouts are funded, and this is quite a sort of a large topic, so I'm just going to give an overview here. But a key point is to understand that it's the business that funds the management buyouts, not the individual managers participating in the deal. The individual managers will probably need to invest some of their own money, and this is often referred to as hurt money. So the principle is that if they were to lose that money, it should hurt, and that hurt money is really just sort of a kind of a sign to other parties in the deal, the other funders, that the managers are serious, they have confidence in the business, and they are going to do everything they can to ensure that the business succeeds and repays the debts that have been taken on to fund the management buyout. That the hurt money that managers invest does vary from deal to deal, but if it's a bank sponsored management buyout where there's a bank investing, lending money and taking a risk, it might be that the bank requires them to invest an amount equivalent to their annual salaries, and that money might only cover the deal costs on the buy side, so the manager's legal fees and the stamp duty and bank arrangement fees, etc. So that hurt money can be a significant amount for the individuals who are having to find that money and invest it, but in the context of the overall deal structure, it's often only a very sort of small portion of the funding mix. But as I mentioned, it does vary from deal to deal. For some transactions where perhaps there isn't a bank involved, the amount of equity that managers are asked to contribute can be a very small amount indeed, just a few £1,000s, or even less than that. So how does the deal as a whole get funded? It really does depend on the nature of the business itself, what its balance sheet looks like, the profitability of the company. But generally, there's only a few sort of different ways of funding a deal. You've got asset-based lending, where a bank or asset-based lender will provide working capital finance secured against specific assets on a company's balance sheet. So typical examples being invoice finance, plant and machinery loans, stock finance. So that's usually the first place to look when considering how a management buyout could be funded, because that's going to be the most easily available and cheapest form of debt finance. So maximizing ABL lending is kind of the first thing to do. That will only usually get you a small way towards funding a management buyout, and therefore, you're looking to banks and alternative lenders to provide term loans or cash flow loans, which will be repaid from the profitability and future cash flows of the business. So this is going to be more expensive finance compared to ABL lending, and more difficult to obtain. It will require a business plan to be prepared, detailing what the company does, who the managers are, and that will include an integrated cash flow forecast, which will show to funders how the loan that's being sought will be repaid and how much headroom is going to be left in the business. So banks are, generally speaking, and alternative lenders, are keen to support management buyouts where there's a quality business and a strong management team, but there are limitations. It's rare that a bank will fund the entire consideration for a deal. They will want to ensure that the risk is shared equitably between themselves, the managers, and the exiting shareholders. So it might be that a bank or a lender will provide, say, half of the overall funding requirements, and therefore the other half needs to be filled by vendor finance, which is deferred consideration. So, but for that reason, it's common that the exiting shareholders will need to be paid out over several years and won't get all of their money on day one. So it's key for funders that everyone is kind of sharing some risk in the deal, and the vendors are showing their confidence in the business and in the management team by accepting a large part of their consideration on deferred terms. For some companies, it can also be a good thing to look at private equity as a possible investor as part of that funding mix. So this tends to be for sort of larger companies with more tangible growth prospects. So lots of pros and cons to consider in terms of whether private equity is right for a particular business. Some management teams, or very often management teams, are keen to try and structure a deal in such a way that they don't need to partner with a private equity investor. But for some businesses, that can be the right thing to do, especially if there's if the business is growing quickly and needs to reinvest and find more money to support the growth of the business going forward. So that's just a very sort of quick overview of management buyouts and the advantages that they offer and how they're funded. As Andrew's mentioned, we do a lot of early stage work with clients to try and help them understand what's possible. So we conduct lots of management buyout feasibility reviews for clients, which would involve investigating a company, speaking to its directors, and reporting back to them on our views on its valuation, what funding options exist for a management buyout, how we would suggest it was structured, and setting out how what the process would look like, and possibly comparing that with other exit options such as a trade sale. So we find that this is often an invaluable sort of starting point for clients, because very often they don't really know what the business is worth, and don't have much of an idea as to how an MBO would be funded. So this gives them that sort of knowledge at the outset, and usually makes a deal far easier to negotiate as well, because somebody independent has sort of given their own view on the valuation, so that can shortcut a lot of the negotiation over price, which is often a big stumbling block between business owners and management teams. So that's the early stage help we can provide, and then where a deal has been agreed and documented in heads of terms, we can then provide a full lead advisory service through to completion of a transaction, and that would be working with the management team and the owners to prepare the business plan that's needed, and forecasts that would go to funders and banks as part of the fundraising exercise, assisting with the due diligence process and ensuring information is supplied to accountants conducting due diligence for funders, introducing solicitors and working with them to ensure that the transaction completes smoothly, and that any issues arising through the process are dealt with. Yeah, it's something that we really enjoy doing. Management buyouts, they're great to work on, and if you do have any specific requirements, we'd be very happy to arrange meetings and discuss how we can help. So I'll hand back to Andrew to see if we've got any questions.
Thanks, Greg. Yeah, this is the opportunity where we'll answer any questions that you may have. So please use the Q&A icon just to ask a question, or if you prefer, if you want to ask something that you feel is too confidential to your own business, please drop us an email or phone us up, and we'll have a chat about your own circumstances. At the moment, I've just got the one question, but as I say, there's time to ask questions if you wish to, using the Q&A icon. So the question I've got, which appears to be from shareholders looking to sell their business to a management team, is asking whether now's a good time, really. And I guess the answer, the quick answer to that is, let us do a management buyout feasibility review, and we'll look at factors pertinent to your business, and be able to precisely answer that question. But I guess the question is more general. Greg, do you want to have a go at that one?
Yeah, I think that's right. Obviously, it depends on the individual circumstances for a company and its shareholders. But looking at the wider economic environment, probably from a tax point of view, now is a very good time to look at a management buyout, and that's because currently there's a very generous tax relief available to business owners, business asset disposal relief, formerly entrepreneurs relief, which allows most shareholders to benefit from paying 10% capital gains tax on the £1 million worth of capital gains. There's been some speculation for quite a few years now that there will be changes to capital gains tax, and that generous tax relief will be watered down or removed. That hasn't happened yet, but there's speculation that will happen possibly next year if there's a change of government. That might be something that a new government would look to change. So at the moment there is a window of opportunity to sell a business and benefit from that beneficial tax rate before they possibly change further into the future.
I guess the other elements to that are, it depends on, as we said at the start, it depends on factors relevant to your business, and how your business has performed over the last year or two, and how it's likely to perform over the next year. In terms of funding appetite, we're seeing plenty of funding appetite. So, it probably is a good time. Certainly in terms of minimizing tax, which is always an objective of vendors. Getting a deal away before the next election is probably something worth doing. Okay, I've got another question, Greg, which is, can you explain how invoice finance as part of ABL works?
Yeah, so it's very common on the transactions that we've worked on to make use of invoice finance as part of the funding mix for management buyouts. So to explain, if you're unfamiliar with invoice finance and ABL, this would be a bank or lender provides a credit facility where the company can draw down a certain percentage of the value of its outstanding sales ledger, and the lender would have security over the company's sales ledger. So this is commonly used as a working capital facility to accelerate cash flows and provide money for working capital purposes, but it can also be used to fund a management buyout. So very often companies have an invoice, may already have an invoice discounting facility that they aren't fully utilizing or not utilizing at all, and therefore that can be used to draw down funds at the point that the MBO takes place. That money would then be loaned to the new holding company that would be set up to facilitate the management buyout. Yeah, and a big advantage with working capital facilities of that type is that they're evolving, so they can just remain in place and be repaid on a flexible basis or not repaid at all. So it might be possible to draw down £1 million using an invoice finance facility, pay that up to a new holding company that would be used to pay out the exiting shareholders as part of a management buyout, and then that money would just sort of continue to be owed to the bank or lender, or repaid depending on how what's most appropriate going forward.
Lovely. Well, that's it, Greg. There's no more questions. So thank you everyone for listening. We have done a recording of this webinar, which will be available later if you've missed part of it, or if you have colleagues who might want to watch it. Thank you for listening. Our next webinar next month is on exit options, principally comparing the trade sale route to the management buyout route. And you're welcome to attend that. Just please enroll on our website. If you'd like to have a chat to us, if you want to have a chat to us about your individual businesses, and talk through whether a management buyout might be right for you or whether a trade sale might be right for you, please do get in touch. I will be emailing you later today or tomorrow morning with the link to the webinar. And if you do want to have a chat, please let us know. Thank you very much for listening.